Hey everybody, welcome. You might have seen this box, this mystery box, sitting around the office. One of you sent me a box, and it's right here. I have no idea what's inside of it. And today, as part of our video, we're gonna find out what's inside. But first, let's take a look at the Magic Carry Trade. Hey everybody. I'm gonna talk about something super important today. And so this is originally was an Instagram live if you're watching it later, but this is going to be a really important discussion about a trade style that I did back in the day. Also, you're watching in between this video today. If you're watching on YouTube later on, you're watching me unbox the package that I got. So happy to see you here. Years ago, when I was just starting out in currency trading, this is like the early 2000s, I was the worst trader ever. I would look at a book about the markets, and then I would look at the charts, and then I would look back at the book, and I would wonder, is this the trade that's in the book? And I would get confused about it. And for the first 2 or 3 years of my trading career, I was absolutely terrible at doing all of my trading because I was trying to get it perfect, and I was trying to make my trades look like the famous person made their trades look like in the book. And what I didn't realize is that the person writing the book about trading might not have actually known anything about real trading or real investing, and they may have just been writing the book to make some money because they were also on TV or whatever. And so that was like a super giant problem for me because I wanted my trading to be perfect, but I was trading a discretionary trading system that may not have ever really worked. And then it was in 2004 that I was in a hotel, I was doing a seminar, and I was with my friend Maxwell Fox. And Max Fox and I came around to the idea that there were some currency pairs that when you bought them, they paid you interest. Like you'd make interest because you bought a currency pair. So imagine this for a minute. You buy the British pound Japanese yen, and you buy it and you hold it. And for every day that you held it, you would get paid interest because the interest rate in Britain from the Bank of England was higher than the interest rate in Japan. And this was, you could just hold on to that trade and you would make interest. But the problem was, if you were holding on to that pair and you bought it and then it started to fall precipitously, you could lose all of the money that you made in interest because the currency pair would fall. Well, holding on to that buy trade and making interest is called the carry trade. And this was famous around the world at the time because interest rates were low in Japan, people would borrow money in Japan, and because interest rates were higher around the world and the stock markets around the world were going up, they would buy stocks with the money that they had borrowed in Japan. And the carry was the interest that people made. So another word for interest was carry, and another word for interest and carry was swap. And you'll see this on currency pairs still to this day. The interest rate in England is higher than the interest rate in Japan. The interest rate in Australia is higher than it is in Japan, and so forth. But back in those days, there was a significant difference between those interest rates. And when the interest rate differential was really big, well, that's when you knew you could make money on the carry trade. So basically for a few years in the mid-2000s, Japanese housewives, and I'm not making this up, would simply buy the Australian dollar Japanese yen currency pair, or they would buy the British pound Japanese yen currency pair, and they would just hold it. And that was their entire trading strategy. And they were stuck in these trades where they had bought these currency pairs. And for as long as those currency pairs went up, everything was fine. But if those currency pairs ever corrected, which they would do one day, they wouldn't be so fine. So I was standing in this hotel room in 2004, 2005 with Max, and we had this idea. What if we could sell a currency pair at the same time we bought it, we would earn the interest on the buy trade, and the sell trade would hedge the buy trade. So we tried that. And the problem was that, here's the major problem, we were making interest on one side of the trade, but we were paying interest on the other side of the trade, and so that didn't work. We were hedged so that if price fluctuated, it was insignificant, but we were losing money every day because we were paying interest on the sell side. Well, it turned into the magic carry trade when we reached out to a bunch of different Forex dealers or brokers, and we said, we want to sell Japanese yen currency pairs, but we don't want to pay any interest. And we're willing to sell those pairs and hang on to them and margin call those accounts. Meaning we would hang on to a sell position, and because those currency pairs were just going up, 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 and they would never stop going up, our sell positions would eventually margin call and would be complete losses. And so one of these brokers, CMS Forex, which is no longer in business, said yes. And that began a trading strategy where we would buy the British pound Japanese yen and the Australian dollar Japanese yen at one broker, and we would put tens of thousands and even hundreds of thousands of dollars to go long in one account, and we would buy it on leverage. So if it would pay 10% a year to hold on to that trade, we had 200 times leverage. So we were making an average annualized return of like 2,000%. And then we would turn around and open tens of thousands of dollars and hundreds of thousands of dollars of accounts at CMS Forex on the sell side. And price would go up on one side and we would make interest, and price would go down on one side and we would not pay any interest, but we would lose those entire accounts. They were perfectly hedged, and all we did was make interest. The entire goal of that trading strategy was to simply make interest without risking that price could go against us. So we were perfectly hedged, and we were making interest. And I that's all I did. That's the only strategy I did for years. And it's where the bulk of all of the money that I ever made on trading came from, was from this carry trade. We just made piles and piles and piles of money. And then one day, John Wiley & Sons, the publisher in New York, offered me a book contract to tell that story, and that's the story inside the book, Adventures of a Currency Trader. And that's what we did, until one day in 2009, when the stock markets were falling and the Japanese yen pairs were falling, CMS Forex reached out to us and said, we can no longer offer you selling without interest. We can't do it anymore. You can't do this anymore. We're not going to provide that kind of account for you. And so the magic carry trade went away. It'll come back someday. Someday it'll come back when the interest rates differential increases again. But for the time that we had it, we were perfectly hedged. If price went up or down, it didn't matter. And on one side we earned interest, and on the other side we didn't pay any interest. And that was the beauty of his trading strategy. Now, let's come full circle on this before we open up the box and we see what's inside of that box. To come full circle, here's the lesson. For the first few years of my trading career, all I wanted to do was figure out which direction the market was going to go. And I was obsessed with this idea that I could follow a trend or pick direction or know when the market was going to burst in one direction or the other. And it didn't work. I was terrible at it. I still am. After 18 years. And then I started trading a strategy that didn't care which way the market went. But I simply earned interest when the market went up, and I earned interest when the market went down. Because I was hedged, I didn't care which way the market went. It was pretty magnificent. It's the reason I trade with robots now, and the robots take hundreds and hundreds of trades per week, buys and sells that balance each other out, and eventually they all come back and make a profit, and I close all the trades. It's directionally ambivalent. And that's the carry trade. The carry trade was buying a currency pair that earned interest and then selling the same currency pair without paying interest. And I know the question for you is, could I do that now? Could that strategy still be done? Well, right now, not really. Not really. But soon, we'll be able to do something like it. As the interest rates in the world start to diverge, and interest rates in some countries go up, and interest rates in other countries stay low, we'll be able to do something like this again in the, I would say, next year or two. And I'll tell you all about it. Thanks for watching. And now let's open that box that came in the mail. All right, it's from Pete in Rock Springs, WY. W-Y. W-Y, is it so cold? Oh my gosh, if anybody else wants to send us anything, I'll put the address below. I mean, anything that isn't dangerous. Ooh, look at this. It's Classico. Molido. Cafe 1820. It's coffee brewed in 1820. Let's see what Pete says. Thanks, Pete, by the way. Hope you're having a wonderful day. Brrr. I heard you talking about some good coffee on one of your videos. I just returned from Costa Rica and got the coffee my wife's family usually uses. Here's a bag of it. Hope you like it. I usually close it really good and put it in the refrigerator after opening. Enjoy and blessings, Pete. P.S. Little candies are also from Costa Rica. These look delicious. I don't know how you eat them. Oh, there they are.